Hey everybody, it's Ian Beaver, Guaranteed Rate. Hope you're doing well. It is April. Hopefully we all got our taxes filed in time, got those put behind us. We can focus on warmer weather and spending more time outside. Spring is upon us. So lots of economic news so far this April. None of it has been extremely helpful to interest rates. We got ISM numbers, we got CPI numbers, jobs numbers, all of which pushed interest rates upwards. They're all showing inflation numbers higher than the Fed's target of 2%. So ISM was up, CPI was up significantly. The jobs numbers, I believe, unemployment actually fell to 3.8% from 3.9%. We added a little over 300,000 jobs when we were expecting to add about 214,000. So all of this is pushing interest rates upwards. We're sitting at the current U.S. Treasury bond. The 10-year U.S. Treasury bond is sitting around 4.6%, maybe a hair higher than that as I give you this recording. It's all pushing mortgage rates up. It's all pushing interest rates across the board. Interest rates on car loans, interest rates on credit cards, interest rates on home equity lines of credit. Across the board, we're seeing interest rates get pushed upwards. Mortgage rates currently are sitting in the low sevens, unfortunately. So we're up about 0.5% or so since mid-March. And the Fed doesn't sound like they're going to be able to make any cuts, or at least they're not willing to make any cuts to their the federal funds rate until likely the second half of 2024. So we'll continue to monitor that, pay attention to that, and hopefully we'll get some good news in a few months. With these higher interest rates, we are seeing demand slow somewhat on a national level. Inventory nationally, as far as the housing market, has increased 23.5% year over year from March of 2023 to March of 2024. Inventory is up 23.5%. Inventory locally in the state of Illinois is down about 4.9%. Inventory in the Chicagoland market is down 23.1%. We touched on this last month. Our local market is still seeing higher than expected buyer interest and very few listings. A lot of buyers looking for places and very few places to buy. So as a result, we're seeing obviously homes appreciate. We're seeing a lot of appreciation, somewhere between 5 and 10% ish, depending upon what market you're in. If you're in a condo market in the Loop, if you're in a multi-family investment market, or if you're in a single-family home market in the suburbs, all these are different markets. So talk to your local agents, find out what's going on in your specific market. But generally speaking, homes are up about 5 to 10%. Homes are still selling very, very quickly. Lots of multiple offers, lots of concessions on the parts of buyers, a lot of appraisal gap waivers, a lot of inspection waivers. A lot of buyers are agreeing to post closing possession for their sellers, et cetera. So homes are going quickly. With this record appreciation, we are seeing a lot of homeowners these days look into possibly cashing out some of their equity. 32% of all mortgages being originated in the country currently are refinance mortgages. So lots of cash out mortgages are happening. A lot of people taking the equity out to pay higher interest debt. If you have a car loan and maybe you're in the 7, 8, 9, maybe even 10% rates. If you've got a home equity line of credit, that may be in the double digits. If you have credit card debt, that's certainly in the double digits, likely in the mid-20s. Could be even higher than that. Lots of people are getting that debt paid off with the equity in their homes. But with this additional debt that a lot of us have taken on, some of our credit scores have taken a hit. So I did include a chart to show you what happens to interest rates, or at least the Fannie Mae, Freddie Mac loan level pricing adjustments to interest rates when your credit score is maybe not as strong as you had hoped and you're looking for max cash out. So if your credit score is lower than a 660 and you're looking to take 80% of the value out of your home with a cash out refinance, theoretically, it would cost a little over 5% to get the market rate of 7.25 or ish, low sevens. Nobody's going to do that. I can't even charge you 5 points. That's predatory lending. We can't do it. So what happens is you get a combination of pushing the interest rate up to help eat some of that pricing adjustment. So you might be looking at a rate close to 8%, maybe even a little higher, and you're paying points. So there are alternatives. You can look at shorter term loans. You can also look at FHA loans if you're eligible. So give me a call. Please reach out, DM me if you have any questions. I'd be happy to help. Lastly, I wanted to leave you with a question. I've seen this on social media a little bit, but if you were going to pay cash for a home or borrow money to finance that home, let's say you got a 30-year fixed rate mortgage at 7% and your home's $500,000, you could take theoretically a $500,000 loan at 7% or invest that $500,000 in the market, assuming you have a financial planner and that individual is able to get you the same 7% return that you would pay in interest on the new mortgage. Which one is better for you financially? Well, as it turns out, it is significantly better for you financially to take that mortgage out and invest that money with your financial planner, assuming you get the same rates of return. And there's even some wiggle room there. The 30-year fix, if you paid 30 years of payments at 7% on $500,000, you pay just under $700,000 in interest over the life of the loan, assuming you never refinance, you made all payments as scheduled. If you were to invest that same $500,000 and you got a 7% return compounded monthly for 30 years, at the end of 30 years, you'd have a little north of $3.5 million in interest profit. So there's that. Let me know if you have any questions. DM me. I look forward to hearing from you guys. That's just food for thought. Have a great April. I will talk to you in May, if not before then. Please reach out with questions. I look forward to hearing from you. Have a great day. Stay warm. Talk to you soon. Bye-bye.